South Africa's automotive sector being under pressure from the 30% US tariff on exports and, of course, shifting consumer patterns. But some also see opportunity with the African Continental Free Trade Area opening new markets in high-growth hubs like Morocco, Nigeria, Egypt and Kenya. Local manufacturers, especially through the sale of components, could deepen their footprint across the continent. We speak now to Luthando Vuba, Executive Head of International Trade at Standard Bank Business and Commercial Banking. Very good evening, Luthando. Let's start off with this. There must have been some celebration at Standard Bank with the positive set of results released today.
Good evening, Taylor, and good evening to your listeners. Indeed, a good day, good set of results. Really gives us something to be proud of to be delivering towards what was promised in 2021 towards the 2025 target. So indeed, a good day.
Let's speak now about the US tariffs, of course, impacting South Africa's automotive exports. How have you seen this so far playing out?
I think the process of this seeing the potential impact on the sector and other sectors that are exporting quite a number from South Africa to and from other African markets to the US. It's a process that began last year already when we were looking at the possibility of AGOA as a beneficial policy for African countries to not be possibly renewed because this year it expires in September. So I think that process in engaging our clients proactively was already, putting on the radar just a diversified supply chain thinking, but also to consider possibility of this impact. Obviously, for all of us, or most of us, no one could anticipate it, just, the shift that has happened since the beginning of this year with the changes and the executive orders that have impacted, the trading environment, and obviously the tariffs one being the most recent. I think in a world where, the 30% remains, or the 30% is revised again, as we've seen in April, a look and a clear strategic focus on the African region for the SA auto sector is one that's an imperative. It is where there's good projected growth to go from $20 billion US dollars in 2024 to grow that to around $33 billion US dollars in 2033, with the also rising supply of alternative vehicles such as hybrids and electric vehicles. I think it really poses the opportunity to intentionally look at the region and intentionally look at that growing base of population globally that we know, the youngest population will be on this continent, which means it's a younger workforce. Most of African markets will be moving into more, higher spending power. So I think it is one that, is an imperative regardless of this changing tariff environment. The AfCFTA provides a good leapfrog from a competing opportunities from a regional perspective. If you think about other regions and what tariffs and trading environment could look like, and there's some good shifts also from some of the sovereigns on the continent in terms of policies that have been put in place to really make it attractive for vehicle manufacturers, component manufacturers, and for assembly lines.
Right. So South Africa's components could potentially be of great value in some of these hubs. Maybe just explain how that would work out.
I think it's important to note that already there's quite a bit that is exported from South Africa in terms of components to the region. Interestingly, you have the likes of Morocco that has done very well in the last couple of years. Just as at 2 years ago, the plants that are producing for Renault at Malusa produced almost 300,000 vehicles. And that they tied this with improvements to the major port, which is Tangiers. So even with that production and other plants that they have, Stellantis and also the Samaka plant, there is still some components that they do import. So I think there are opportunities, though, could be seen as a competitor to the SA auto sector. There is opportunities to look at those partnerships to supply into, some of those specific components. Egypt is another one that has advanced quite a bit in this space, probably a bit not as further ahead as Morocco. And also to move to more central West Africa, Ghana has put in a policy in place, and VW has been the first move of that for really looking at, incentivized foreign direct investment for auto manufacturing and assembly lines, and that too would require in that value chain supply of components, and also the policy looks to attract component manufacturers. So in Nigeria as well, there's special economic zones that is looking at this particular value chain. And interestingly, Kenya and Rwanda has been advancing quite a bit in the EV space, looking at EV and supporting EV mobility with, the pilot projects that we are seeing in the likes of Rwanda, and looking to open up for foreign direct investment to look at assembly of these vehicles. So I think there's good shifts in different pockets, in different parts of the value chain that present opportunities, not just, at a private sector play, but the policy that supports it and other incentives such as, special development economic zones that make it attractive for foreign direct investors.
And how would South African companies be able to pivot? Because it does take a while to change the trade flows. Would they be able to do this almost seamlessly without too many jobs lost?
I think it's a very interesting question, but you have to think of it in terms of what is in the short term, and then some of these will be short to medium term because supply chains don't change overnight. But I think the immediate opportunity is in what is produced, has opportunities on the continents to be supplied to. I think furthermore, the manufacturers that are manufacturing in South Africa, like BMWs or Mercedes, Ford, they ought to have opportunities to strategically look at the region where they could export into. And that's probably your more medium to long, short to medium play. But I think as the FCFTA as Secretary is putting all these measures in place and advancing the free trade rules with more of the countries that have signed the agreement under the Guided Trade Initiative, it does then start to make more of these markets open to start trading under free trade rules, which is another beneficial incentive. And that is as immediate as that gets into place. But obviously, brokering the right relationships is where it needs to start. So I think prioritization should be in engaging these markets strategically. And I think while private sector can advance that, and certainly the auto sector, it's very important that government plays also their role, because some of these are also accelerated through strategic bilateral engagement. So I think Ghana is a good opportunity, Kenya is a good opportunity, and even North Africa, the likes of Morocco and Egypt, present those opportunities. So I think those engagements, but importantly, ourselves as kind of bank who are in 20 of these African markets that we speak of and have some years in the game, also, that partner to help, engage the sector, help the sector engage some of these markets, expand and looking for those opportunities.
I'm glad you touched on government's efforts, because the automotive sector does get a lot of support from government. What are the kind of policies or actual monetary or subsidy support that you think the automotive sector requires in order to make a shift towards the new markets or to growing the markets in Africa?
I think it has to be very intentional. I think it has to be policies that are looking both at the now and the future. And I already mentioned, alternative vehicles such as electric and your hybrids. And I think it's important also to pay attention to the shift in the consumer demand. You are seeing more imports from the East coming into SA and landing on our roads. And it's not just about them being a cheap alternative. It's also what the consumer is preferring. I think similar challenges that the auto sector is facing here and other parts is also being faced in the likes of China, where the expected demand that's supposed to come from the younger population is not happening because they're just not preferring to own vehicles because of such a world-class standard transport system, high-speed rail, that's long distance, options of e-hailing services that are very efficient, good infrastructure to enable all of those. And so there is that shift. So I think our auto sector needs to start thinking around that, very sort of integrated or future of demand for vehicles, but also what the demand and kind of auto or vehicle demand would look like in the short, in the medium to long term. And I think that's very important, particularly in a market such as South Africa, which is, where it's a very sort of common buying a new vehicle, a range of different vehicles. But when you look at further on the continent, we still have, a dominant secondary market. 68% of the vehicles and on the continent, are used vehicles.
Right.
The likes of Kenya, where they import over 90% of those, are used vehicles. So it may be the case here, but it's still, opportunity pockets in other parts where, there's still a demand for, newer vehicles, luxury vehicles, but definitely vehicles that are able to navigate the terrain of different countries. So
Right.
I think those are sort of the insights that should inform what policy shift, what strategic direction the sector looks at. But certainly one that has the continent in mind and how to supply into this big market.
All right, thanks very much. We've been speaking to Luthando Vuba, who's the Executive Head of International Trade at Standard Bank Business and Commercial Banking, discussing the opportunities for South African automotive components as well as cars on the continent.